Hello and welcome to Close of Business. I'm Alicia Barry. Home prices have risen for a fifth straight month, reaching a record in some capital cities. The gains are being driven by falling interest rates, but for some homeowners, the RBA isn't cutting fast enough, with more people struggling to pay their mortgage. As Nadia Daly reports.
68-year-old Patricia McGarry always hoped to own her own home. And finally, 8 years ago, she did it.
It's called Warner's Safe Cure, and it's got a picture of a safe, and it's from Melbourne. It was just my dream home, and I was so happy to find it. Now it's a beautiful home, and I've filled it with treasures.
But it's a dream she's now at risk of losing after health issues forced her to leave her job.
When that all happened to me, I went on Centrelink payments, and that just more or less the job seeker, which was about $384 a fortnight. I could not pay my house payments then because things got out of control with everything. Not just the house payments, everything in life. I didn't have 2 bob to scratch.
Now Patricia's facing the prospect of having to put her home on the market.
They did tell me that maybe I should just sell up and go live somewhere else. And I thought, no, I'm not doing that. I want to live here. This is my home.
Claire Tackon from the National Debt Helpline says she's seeing more and more people in Patricia's position.
Since May 2022, when interest rates first started to rise, mortgage arrears became the most common issue that people contacted us about.
The data paints a similar picture. Cotality found the number of Australians behind on their home loan repayments is up to 1.7% in the first 3 months of this year, though it's coming off a low base.
Amid high interest rates and what was recently clearly a cost of living crisis, it's probably no surprise to see arrears have risen.
But rising house prices are cushioning the blow, allowing some homeowners to sell up before their properties are repossessed. Prices rose for a fifth straight month in June, increasing by 0.6%, taking the median home value to more than $837,000. Darwin led the monthly gains, followed by Canberra, Perth, Brisbane, Sydney, Melbourne, Adelaide and the regions, while prices in Hobart fell.
The biggest factor here absolutely is lower interest rates, and I don't think it's a coincidence we started to see housing values rising after a brief downturn in February.
Data from real estate group's PropTrack report showed a similar trend.
So far this year, it's the capital city markets that are leading the upturn and recovery in home price growth.
Price growth is expected to continue with more rate cuts on the horizon, but property analysts think it will be contained.
There's still a lot of constraints in housing markets, particularly affordability constraints that are holding back a higher level of growth as we do see interest rates coming down.
We know that growth in household incomes hasn't kept up with that continued lift in home price growth that we've seen in recent years. And although interest rates have begun to fall this year, affordability is incredibly challenged at the moment.
Something Patricia McGarry is all too aware of as she tries to keep on top of her mortgage and keep her house.
Don't go out at all. I'm just by myself with my 4 kitty cats. And as long as they're healthy, I'm happy. I've gone without to make sure that they get their goods. And when I did my shopping last week, all I bought was cat food.
Cutting back every way she can to hold on to the Australian dream.
For more on just how high prices can go, Ray White's chief economist, Nerida Conisbee, joined me. Nerida Conisbee, welcome to Close of Business.
Thanks for having me.
The upswing in home prices really got underway when the RBA started cutting interest rates in February. With a July cut a near certainty, more gains on the way?
There's definitely more gains on the way, and end of last year we were starting to see a bit of a slowdown in the market. Every state saw a drop in house prices in November and December. We saw that rate cut in February, things started to pick up, another one in May, and June data is certainly showing that things are accelerating pretty quickly.
Well, AMP is expecting home prices to rise between 5 and 6% this year. Where do you see home prices going, and where do you see interest rates going, crucially?
So at the moment, house prices have risen 7% over the past 12 months, but June was a particularly strong month. So if we do continue to see June growth rates occurring through the next 12 months, it is likely we'll see price growth of in excess of 12%. It will accelerate even more potentially if we do see a lot more interest rate cuts. So next week is almost a certainty that we'll see a rate cut on Tuesday. Depending on who you ask and depending on what metric on what data you're using, it is likely we'll see 2 or 3 more cuts. So obviously that's occurring because of weakness in the economy, but we do know that lower interest rates leads to higher house prices as demand starts to increase.
Well, in terms of accessing the housing market, Melbourne, the country's second biggest city, is now the 6th most expensive city. What's going on there?
It's a little, quite a few things actually that are happening. So we're still seeing population growth in Melbourne. There's still high levels of international migration. So there is pressure there, but we do have the highest unemployment rate in Victoria. We don't quite know if Victoria's in recession, but it's likely seeing the lowest economic growth of all states, barring Tasmania at this point. And also it's a very highly taxed state. So we have seen quite a significant exodus of investors. In particular, it has led to a reduction in rental properties. But at this point, the interest rate cuts do seem to be helping. We did see some pretty decent growth in June, but overall it looks like it's going to continue to be the slowest state, primarily because of that high taxation.
Well, the booming cities of the last couple of years like Brisbane, Adelaide and Perth are continuing to see solid gains.
Very solid gains and really driven by population movement, primarily up to southeast Queensland, pretty much the area actually from northern New South Wales, Byron Bay up to Tweed Heads, Gold Coast, Sunshine Coast, Brisbane. There's just such a lot of population growth moving up there, and they're not really building enough homes to accommodate the level of demand. So we're seeing places like Ipswich, very, very affordable market prior to the pandemic, median price of sort of 350, 400,000, now in excess of 750,000. And very similar situations in Perth and Adelaide. Perth is actually moving the fastest of all capital cities. It has slowed from mid last year. Prices were increasing by about 25%. It's at about 11%. But obviously more interest rate cuts will likely lead to an acceleration of price growth.
The median house price in Sydney is over $1.2 million. How are houses performing versus apartments across the country?
It's quite interesting to have a look at markets, the smaller markets of Perth, Brisbane and also Adelaide. We're actually seeing unit prices move more quickly than house prices. We don't often see that. It's often the case that house prices do better over the long term, but we're not seeing much construction at the moment. It's very, very difficult to get apartment projects up and running. Construction costs are very expensive. It's very difficult to build at rates that developers were able to build sort of 3 or 4 years ago. So it is likely that this challenge we have with apartments will continue. Luxury apartments are still getting built. They do, obviously, luxury apartment buyers are far less cost sensitive, but trying to get affordable apartments will remain very difficult.
Nerida Conisbee, thank you so much.
Thanks for having me.
This week, Australia's biggest airline revealed millions of its customers have been targeted in a major cyber attack. On Monday, Qantas detected unusual activity on a third-party platform used by its contact centre in Manila. That platform holds the records of 6 million customers, including names, email addresses, phone numbers, birth dates and frequent flyer numbers. But the airline says it doesn't hold credit card details, personal financial information or passport details, and frequent flyer accounts haven't been compromised. 4 days later, CEO Vanessa Hudson fronted the media to publicly apologise to customers, saying the airline is focused on transparency.
What I would first like to say is acknowledge the impact to all our customers. And first and foremost, I'd like to apologise to them. I know this data breach is a serious concern. I know the stress that it has created for many millions of customers that we've had.
Qantas says customers can access further information on the website or via a special phone line set up to deal with the incident. The collapse of a $590 million investment fund, First Guardian, has wiped out the super savings of about 6,000 Australians. Its director is being accused in the federal court of using millions of dollars from the fund for personal purposes. Investors have been told it's unlikely they will see a cent of their retirement savings. Mackenzie Colohan and Nassim Kadem have been investigating.
He wants a discount on it, and I'm waiting on Tasty Spices to offer us a discounted price. That's why
Juan Carlos Sanchez runs a family-owned food wholesale business his grandparents started in Melbourne in the 1950s.
It's a long drive for him, so I want to make sure he gets out early.
He's worked hard his whole life and put money away for retirement, but the 41-year-old says a decision to change superannuation providers may have cost him his life savings.
You know, they'll talk in numbers of, we'll have you $800,000 in your super by the time you retire, $1 million, you know, really crazy things like that. And unfortunately, I fell into it a little bit and I got a bit excited. That's all right, all good, beautiful.
He was sold a dream by financial advisory firm VentureEgg, whose telemarketers convinced him to leave ANZ and transfer his super to Ozprac. The money was then funneled into a managed investment scheme called First Guardian that collapsed this year after withdrawals were frozen. Juan Carlos was told in January that he and 6,000 others stand to lose $590 million between them.
When I got that email, my stomach dropped. I've spoken to some people in their mid-60s, $350,000 gone.
The federal court has slapped travel restrictions and asset freezes on directors of Falcon Capital, the trustees behind First Guardian. According to court documents filed by the Australian Securities and Investments Commission, it's alleged one of the directors, David Anderson, moved $274 million into offshore companies tied to him shortly after he was alerted to the corporate watchdog's probe. Tens of millions of investor cash was also poured into his own failed property developments, craft breweries and a struggling restaurant group. $5.5 million was allegedly transferred into his personal bank account, some of which was used to make a mortgage payment on his $9 million Yarra Riverfront home, and $45 million was paid in marketing fees to lead generators who used a network of financial advisors to funnel investors into the scheme.
We think this is on an industrial scale.
Mr. Anderson declined to be interviewed, his lawyer telling ABC News he did not wish to participate in a trial by media and that ASIC's allegations were untested in court. Christian Eriksen had all of his $140,000 in retirement savings invested in First Guardian through superannuation platform Netwealth.
As far as I was aware, every entity in that superannuation platform was a government-regulated superannuation fund.
The 59-year-old had planned to retire this year, but will now have to keep working or sell his home.
It's just astounding. That just really makes me angry that someone wasn't doing their job to allow this to happen for so long.
Mr. Eriksen isn't the only one with questions about the oversight of high-risk managed investment schemes and their relationship to financial advisors and superannuation platforms, including those offered by major investment firms, which ASIC says needs to do more to protect people's superannuation.
Because some of these funds sat on platforms like Macquarie or Equity Trustees, they thought that gave the funds some kind of legitimacy. In fact, some of them thought they were investing in Macquarie funds themselves.
Investors also blame regulators for stepping in too late and want the government to cover their losses.
Whatever checks and balances are put in place, they're not fit for purpose. They don't work, because if they did, we wouldn't be in this situation.
Greg not only had his super tied up in First Guardian, one of his clients was heavily invested too. When they went bust, he was left with a number of unpaid orders.
People don't seem to realise this can happen your super. your super can go. It can just disappear.
ASIC says it's usually only alerted to problems when it receives complaints.
These investors, we acknowledge, are in an extraordinarily difficult position. We have acted on the information available to us as quickly and with as much force as we consider we've been able to do.
The people that are responsible for this, I hope that they watch it one day. You're ruining people's lives.
Leaving many to rethink their future.
From this week, the minimum super contribution from employers has risen to 12%. But new figures reveal some employers are currently underpaying workers about $5 billion a year in super. More than 80% of that goes unrecovered. But experts say new laws could end the problem almost overnight. Reporters Adelaide Miller and Daniel Ziffer filed this report.
Richard Aichinger has been advocating for his 19-year-old son, who hasn't been paid superannuation from his employer for more than a year.
He's asked his bosses a couple of times, just keep getting the answer that, they'll be paying it soon.
Unpaid super is a problem worth more than $5 billion a year, affecting 2.8 million people. More than 80% of it goes unrecovered, with the average underpayment worth almost $2,000.
Every week in Australia, $100 million that is owed to workers in super does not make its way into their super accounts.
Industry insiders say some employers have been using super like a credit card.
It's gambling because you're actually using working capital which is not yours. It's actually an employee's future super.
As of July next year, if laws pass, employers are set to pay their staff super at the same time as they pay their wages, in what's known as payday super.
The frequency of pay is much faster, which means the errors will be detected earlier.
Coupled with electronic pay data matching the amounts owed.
Those tools are there. They should be being used by the ATO.
In a statement, a spokesperson for the ATO said,
in 2023-2024, a total of $1.91 billion in superannuation liabilities was raised through ATO compliance, proactive reminders and prompts.
The superannuation rate for every worker goes up to 12% tomorrow, but only if it gets paid. The ATO issued almost 10,000 penalties for businesses with unpaid super in 2020. The vast majority of them simply paid back the money they owed to workers in the first place.
Tesla's position as an EV market leader is still in the rear vision mirror as deliveries continue to slump. Sales fell by nearly 14% in the second quarter, despite assurances by the Tesla CEO, Elon Musk, that the company had turned a corner. Analysts say anti-Musk boycotts are continuing to hurt demand. Tesla needs to sell over 1 million cars in the next 6 months to avoid another annual decline. The collapse of one of Australia's biggest fashion retailers is ricocheting across the world. Mosaic, which owns Rivers, Katie's and a host of other chains, collapsed earlier this year. Hundreds of workers in Bangladesh have already lost their jobs and more may follow. This report from Asia Pacific Network reporter Libby Hogan.
This factory in Bangladesh is struggling to pay its garment workers after the collapse of Australian retailer Mosaic Brands.
We are now really hopeless and I don't know what's going to happen.
Mosaic had chains like Rivers and Miller's. Its debts total $360 million, including $2.5 million to Jabed's factory. He's had to lay off around 500 workers, most of them women supporting young families.
Here I have more than 2,500 workers working under my umbrella. More than $500,000 per month we pay wages and salaries for our workers.
Here in Australia, thousands of people who worked in Mosaic stores have already been paid back some of the $21 million they're owed by a government scheme that guarantees workers' wages. There's now question marks over the company's conduct.
So the safe harbour laws in Australia provide a defence for directors against personal liability for insolvent trading. The administrator's report in this case suggested that there was a strong argument that there had been insolvent trading for years, potentially up to $77 million.
Mosaic's administrators held a vote with creditors today. The deal they agreed to will see lenders and employees get back almost all of what they're owed, but for unsecured creditors like the factories in Bangladesh, they'll get back next to nothing. More than 20 Bangladeshi factories claim they're owed $30 million for clothes they've already made.
We understand that this is a cheating company. They have not kept the payment due date.
Experts say the factory's best chance now is legal action to try to recoup extra cash.
Donald Trump has stepped up his campaign against the US Federal Reserve Chair this week. Mr. Trump has wielded the presidential texter, accusing Jerome Powell of being too late in cutting interest rates. The president sent Mr. Powell a list of central bank rates around the world, with handwritten notes in marker pen saying the Fed should immediately slash rates to 1% or less. US borrowing costs are currently 4.25 to 4.5%.
The president sent this note to the Fed chair. It says, Jerome, you are as usual too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost and there is no inflation.
Mr. Trump added the job of the independent Fed chair is the easiest in the US and Mr. Powell has failed. To the share market, which closed the week with a fresh record. The ASX 200 and the All Ords both adding more than 1% each. For more, I spoke to Deputy Portfolio Manager with Wilson Asset Management, Anna Milne. Anna Milne, President Donald Trump's big, beautiful bill essentially makes America's long-term debt problems worse, but investors seem to like it.
Yes, so the market hasn't really reacted to the big, beautiful bill. Most did expect it would pass, but you're right, it does add $3 to $5 trillion to the fiscal deficits over the next decade. What the market was focused on last night was the unemployment data. It was highly awaited and it came in better than expected. That provided the market some comfort and the markets rallied on the back of that.
Now, there was a bond market sell-off, if you like, those bond vigilantes out after Liberation Day. Do you think we could see that again on Liberation Day Mark II? And this is only likely to push US borrowing costs higher, isn't it?
You are right. There has been a lot of focus on foreign investors pulling their US treasuries and what this means for the treasury market as a whole longer term. I think the concerns are overblown. They're well known, but they are still ultimately at the margin, so we don't expect the same impact this time around. Shorter term, looking at interest rates, we don't expect the Fed will cut this month either. Firstly, the fiscal deficit implications from the bill, and then secondly also the jobs data means that there is no need at this stage to cut rates.
In Australia, miners were very much in focus, a big rotation into them this week, but it didn't last the whole week.
It did not last the whole week. They have been softer on Friday. And what we've really seen hasn't been anything fundamental necessarily, but it has been more market flow. And we've seen the other side of this trade being the big four banks, particularly CBA, which has had the strongest run and is now retracing slightly.
Of course, one stock in focus was Qantas. It's been hit by a big cyber attack, but investors don't seem too worried.
You're right, the stock hasn't really reacted and it is hard to really measure what the financial impacts of a cyber incident could be. Firstly, they do have cyber insurance, and secondly, we now have a few examples. We've had Medibank, we've had Optus, and the biggest impact on these companies is really brand reputation more than anything else. So we expect Qantas will suffer from a brand perspective for a period, but ultimately what investors are focusing on is the fundamentals of the business. Demand is strong, pricing is strong, and costs are under control. It's a healthy market for airlines at the moment, and we've seen that with Virgin as well.
Well, Helia and Domino's were two stocks in focus this week. They both fell really sharply. What was going on?
The reason both stocks fell really sharply was that they were shock announcements. So for Domino's, there was no expectation that the CEO would depart after only starting the role recently. Our view on that is that there needs to be some pretty significant changes in the Domino's operating model, and they need to happen really quickly. Not only is franchisee profitability challenged, but the likes of Uber Eats have really challenged these incumbents such as Domino's. So that's been the driver of Domino's. Helia, similarly, big shock. So a few months ago, they lost the CommBank Lenders Mortgage Insurance contract, and now they have lost the ING Bank. This is a large proportion of their revenue, and so the share price has been warranted. The question here is whether they can reduce costs accordingly.
Anna Mill, thank you so much.
Thanks, Alicia.
It's been called a $3 billion gift from taxpayers to the big telcos. The media watchdog is proposing to roll over existing contracts for spectrum licences instead of holding auctions for them. Critics say if it goes ahead, the public will be shortchanged and dominant players like Telstra will be entrenched. Daniel Ziffer reports.
The airwaves that support our calls, our work, our lives are worth billions of dollars. But the regulator doesn't want to hold new auctions for what's known as spectrum. Instead, it's proposing to roll over current licences, giving Telstra, Optus and others cut-price ongoing access to public airwaves.
It's hard to know why they would do that, and certainly not in the interest of the Australian taxpayer.
69 expiring spectrum licences were bought for $8.2 billion. But the Australian Communications and Media Authority, ACMA, wants to roll them over to the existing holders for between $5 and $6.2 billion.
Well, taxpayers will be losing between $2 and $3.2 billion. That's shortchanging Australian consumers.
ACAN commissioned Professor Richard Holden to analyse ACMA's proposal.
Why don't we just run an auction and find out what we get? And if we get $5 billion, then fair enough. But if we get $10 billion or $12 billion, then that'll be better for the taxpayer.
The regulator says rolling the contracts over is the best option. Spectrum is a public asset for which industry should pay a fair price and from which consumers should gain maximum benefit. Existing players say no matter what happens, the cost is passed on.
There's a direct relationship between the price that's paid for spectrum and ultimately the price that consumers pay for their services.
The thing about auctions is you never know who might turn up. By rolling over the licences, we're locking in incumbents and locking out potential competitors and new technologies.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.